Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Letter and Banking on Profits Report, coming to you from very sunny and warm Central Florida this Sunday. Going to be up in the 90s again today, maybe a little late afternoon thunderstorm action. But as I've always said, you don't shovel sunshine. So I continue to just absolutely love living here. Anyway, the stock market was up more than 1% again this week. That's the fourth time in the last 5 weeks that we've had 1% plus gains out of the stock market. And the major themes have not changed at all. Everybody loved the fact that the Fed said the economy's growing a little slower than we expected. So, we're going to taper our stimulus packages, but very, very slowly. And we're going to keep interest rates low for an extended period of time. It's going to be 2015, possibly 2016, depending which economist's wild guess you choose to consider, before we see the Fed take aggressive actions as far as raising interest rates. That makes stock traders a pretty happy bunch. We continue to see a lot of M&A activity as well, and that's supporting the stock market quite a bit. We've had the highest volume so far in June of any month since 2008, and we still have a little week and a half left to go in the month. We have had 124 billion of deals so far in the month of June, and folks expect that that pace is going to continue for a little while. When markets and stocks have risen for an extended period of time, um, there's a lot of cheap currency to buy other companies. You can use your own overvalued stock to grow the size of your company. And since there's not a lot of what you might call organic growth in the economy, it makes sense. If you want to grow, you got to buy some of your competitors. So we're seeing a lot of deal volume. We're also seeing just enormous volumes of stock buybacks. The first quarter, we saw $154 billion of stock buybacks done. That's the third largest quarterly volume since 2005. All of this is fueled, of course, by the fact that, again, there's no organic growth. There's not a lot to do with the cash in some industries, I think particularly technology right now. And they've got a lot of cash that they've accumulated. So they're buying back stock to bump that earnings per share number up where they want it to be. And of course, a lot of the companies like Apple are using debt, to very cheap debt. They're issuing it at ridiculously low rates, and we're even starting to see 50-year deals to lock in these rates. And they're using the cash to buy back stock and push their stock price up. Does that work in the long run? No, I don't really think it does, but it's here and we have to deal with it for now. That's another factor that is supporting stock prices. Everybody continues to discount and ignore what's going on in the Ukraine and in Iraq. Perhaps they are correct, but I think those trouble spots always have the potential of flaring up and causing us additional problems. Anyway, sat down over the course of the week and gave a lot of thought to exactly how we've constructed our deep value portfolios and our approach to investing over the years. Now, I've read pretty much every major book and a lot of the minor ones that have come out on the subject of stock market investing over the course of my career. Now, if I wanted to be a great football quarterback, well, first I'd have to grow about a foot and put on about 75 pounds or so. But I would study guys like Johnny Unitas and Joe Montana and perhaps Roger Staubach and some of the truly great quarterbacks. And I would watch game film and I'd read what they had to say about how to play the game. And I try to add what made them great to my arsenal of tools. Same thing with if I was going to be a baseball pitcher. I'd be looking at film of Sandy Koufax and reading about guys like Nolan Ryan and Greg Maddux and exactly what made them great and their approach to the game. And I would try to emulate that. Of course, I'd have to also grow a foot taller, put on a few pounds, and learn to throw a baseball 90 miles an hour. So that's probably not going to happen, but that's the approach I would use. I would study those guys. In philosophy, if I wanted to be a great philosopher, I would read, of course, Socrates, Aristotle, John Locke, all the great philosophers of the last several centuries to see what made them tick and how they approached the subject of what is the meaning of life. But my point is, if you want to be good at something, study the greats and see how they did. Done that over the years, and I've picked up some folks that really have become like the guiding lights of my approach. And I really try to emulate my investing style on them. I always get a kick out of when I talk to guys, especially guys that like the trading and the action and that. And I'll ask them, who do you base yourself after? one of the biggest answers, the most frequent answer, is Jesse Livermore. I mean, Livermore was a bigger than life figure and he dominated Wall Street at certain times, but I'm not really sure I'd want to emulate the guy. He went broke at least 3 times, and he was so despondent over his losses that he eventually committed suicide in a Manhattan hotel lobby. Not quite sure that's how I want my life to go. Some folks will tell me Bernard Baruch, and I think that's an interesting answer. Baruch was a trader and a speculator, but he was much more a financier involved in deals and putting companies together and that type of thing. But he also had two really important pieces of wisdom that most of his followers don't follow. One is only speculate if you can do it full time. Now, there's so many people out there that think they can come home from work, sit down on the computer, draw a few lines on charts, and become successful speculators. Doesn't work that way. I know a few really successful speculators. They work 12, 15 hours a day analyzing the markets and trying to position and get their trades on. He also said, and none of the technicians, or very few, I'm going to qualify that, very few of the technicians that I know ever bother to do this. How many times have you heard a guy say, I don't need to know what the company does, I just need to see the chart? Well, one of the more successful speculators in history, Mr. Baruch, said, never put your money at risk until you have a full and complete understanding of the fundamentals of the particular company. So most of the guys that I talk to have not, they don't seem to have done the study. There's this belief that we can do this short-term thing and act like Jesse Livermore and be the big swinging guy on Wall Street. It's not going to work out that way for most of us. Now, in my approach to the markets, I have three what I call guiding lights. One, obviously, is Ben Graham. Ben Graham invented this whole deep value investing thing. He's also the forefather of what I like to call the private equity mindset. He advised us in all of his books to approach investing like a business, to understand that you're not just buying a little electronic blip going across the screen, but buy the stock like you were buying the entire company. Value the entire company and try to buy it at a discount to that value. Run your portfolio like a collection of businesses. He also introduced one of the most important concepts, and it's been expounded on by Seth Klarman and some others, and that is this central concept of successful investing is the margin of safety. Always ask yourself first, not how much can I make on this particular stock, but how much can I lose if I am completely and entirely wrong in this situation. Put margin of safety first, and the profits will take care of themselves. He also introduced us to our manic depressive friend, Mr. Market, and he advised us that some days Mr. Market was going to be very excited about the prospects and what was coming up in the future, and he would overvalue what his business was worth. At that time, you should sell your shares in the business to our partner, Mr. Market. When Mr. Market's in his depressive cycle, he thinks that the world's going to come to an end. Everything is very much doom and gloom, and he'll be willing to sell you his shares in the business at a very low price. Ben Graham always advised us, make sure that you have Mr. Market working for you and not against you. It's one of the key concepts of investing. He also really is first to develop the quantitative approach to deep value investing. In the last major study that he did before he passed away in the 70s, he had done an extensive by hand back test of market conditions and found that you could apply just a few simple factors, either earnings or assets. According to Mr. Graham, one of his last interviews, it didn't matter which one you used, PE ratio or price to book value. Clearly, I favor price to book value. But just a package of quantitatively cheap stocks and hold them until they actually appreciated was an incredibly successful and beat the market by a huge percentage. So obviously our first guiding light is Benjamin Graham. He invented this stuff. He pretty much perfected the ideas, made a lot of money for himself, and ended up living a very comfortable retirement out in California. Now, the second one is one of Mr. Graham's students, Walter Schloss. I very much base my approach on Mr. Schloss' approach to the market. This man was incredibly successful without ever really becoming very famous. He never wanted to be the biggest. If he got over a certain size, he returned investors' money rather than have to deal with the headaches of managing more money. Mr. Schloss left us a list of investing maxims, chief of which is price is most important as in relationship to the value of the company, not what moving average line it crossed or what triangle pattern the price formed, but only in relation to the value of the company. He also said to use book value to buy assets, not earnings. Earnings can change rapidly. A decent accountant can change the same earnings report instantly. Assets change in value at a much slower rate. So focus your attention on assets, not earnings, to find investment success. He also advised to be patient. I think they figured out that his average holding period was just about 4 years for the stocks in his portfolio. He wasn't trading in and out of things. He was a scale buyer and a scale seller. He would buy stock in an undervalued company, buy a little more when it went lower, and when it came time to sell, he would also sell on a scale basis. So, he liked to buy the lows, not just of the last year, but of the last several years. So he was looking for stocks that are trading near 3, 4, and 5 year lows in order to make sure he was definitely getting a bargain. Just because a stock has dropped in the last year from, say, 50 to 40, that doesn't mean it can't go to 20. So he's looking for the lows of the last several years of stocks that are, also conveniently trading below book value. He owned a lot of stocks at any given point in time, on average at about 60 in his portfolio during his long career. At times, when markets were falling apart and bargains were plentiful, he owned 100 and more stocks in the portfolio. He used the diversification of owning lots of cheap stocks to provide a margin of safety. How did he do? 47 years his firm was in existence, and before fees, he averaged an annual return of 20% a year. I don't know of any other track record. More importantly, he said that his method and approach to the market was easier to implement, as he called it, more fun, and more available to individual investors than trading in and out and trying to compete with the professionals. If you had the patience to buy stocks below book value and waited until they trade closer to their fair value, it's a very easy approach to replicate. You can do that in a few hours after work in the evenings during the week. You're not competing against the guys who are using computers to trade and are working 12 hours a day. So the approach was easy to replicate for individual investors. And that's one of the major reasons that Walter Schloss is also another one of my guiding lights. My third one is my pig farmer friend, Mr. Womack. I've talked about him constantly. He was introduced to us in a 1978 Fortune magazine by investor and author John Train. Mr. Womack was a pig and rice farmer down in the Houston, Texas area. And on balance, the man never lost money in the stock market in his life. Not all of his stock picks went up, but year in and year out, his portfolio went up in value. How did he do it? It was real simple. Now, they didn't have the internet and all the instant communication stuff, but when Mr. Womack came in from the fields at the end of the day and he read the evening paper and he turned the TV news on, and when everybody was scared and panicking and selling stocks at a very rapid rate, and the newscasters and the pundits in the newspapers were talking about the Dow Jones going down another 100 or 200 points or 10%, and just nobody wanted to own stocks, he would hop in his pickup truck, he'd drive into town to the local Merrill Lynch office, and he would buy a bunch of stocks. Then he would go home. He would not really. The stocks, by the way, tended to be cheap stocks, and they all paid dividends. He did insist on getting paid a dividend. As he said, it was the same as buying pigs. You buy them when the market's cheap, with the advantage that pigs, of course, do not pay dividends. Mr. Womack would then go home. He would go back to farming, hunting on his lands, whatever it was he wanted to do, until one day, several years later, he'd come home and he'd pick up that evening paper and he'd turn on the TV, and everybody'd be really excited about stocks. And the big news would be how much the Dow Jones has gone up this week and how much it's going to go up over the next year. At that point in time, Mr. Womack would get back in his truck, drive back into town, and he would sell all the stocks. And he would go home and wait for the news to turn negative again. He never sold the exact top, never sold the exact bottom, but he was bought the exact bottom. But he was always buying in that bottom part of the 3 to 5 year trading range of the market, and selling in the top 20% or so of the market's range over that time period. He was buying low and selling high, something that most people just do not have the patience or the discipline to do, in my experience. Mr. Womack was a very interesting guy. This sounds a lot like John Templeton's advice to buy at the point of maximum pessimism, or Seth Klarman's suggestion that we be the buyer of last resort in a particular asset class. But really, it was perfected by Mr. Womack. And again, never lost money in the stock market. I think that's critical. And he made an enormous amount of money in the market simply by buying cheap, cashing dividend checks, and being very, very patient and going against the crowd. That is really my three guiding lights: Ben Graham, Walter Schloss, and Mr. Womack. We want to buy cheap stocks, trading below book value, and we have a preference for buying when everybody else is selling and selling when everybody's super excited about the markets. It's worked for a long time. It does require patience. It does require discipline, and there's not a lot of casino-like activity in your day-to-day portfolio. However, as I've always told everybody, if you like that type of thing, I suggest that you take up horse racing or poker or something a little bit more fun than speculating with your retirement account. So anyway, we have a very busy week coming up. We have existing home sales. We have new home sales as well. Now, it's going to be very interesting. It's just this week, Fannie Mae lowered their forecast. They're actually now projecting, instead of a 10% gain in home sales this year, they're saying it's going to be lower for the first time in several years for combined new and existing home sales. Housing market has been suggested as a key driver of economic growth going forward. And if the markets are in fact going to slow down, that could create a problem. I'm watching these numbers with a great deal of interest because I don't think housing is as strong as some folks might have suggested it has been. We also get consumer confidence, and we get the Michigan consumer sentiment number this week. So we'll see how good everybody's feeling about ourselves and our willingness to spend money over the second half of the year. And unfortunately, a couple of Fed officials are going to be allowed out to make various speeches and commentary, and that's always a potentially market moving event. Anyway, we've got the Orioles and the Yankees this afternoon, so I'm going to slip out and try to watch a little bit of that. It is a nice sunny day, so perhaps go sit by the pool and read a book for a little while. But thanks for watching. This is Tim Melvin, and I'll talk to you guys next week.